ARK Invest was hit hard in 2022 with their popular ARK Innovation fund falling over 56% for the year. And on top of that, the sell-off actually started in 2021, with the peak being much higher and the ETF losing about 3/4 of its value since then. But what's surprising is that people have decided to not only stick with Cathie Wood and the team of analysts at the investment company, but to put even more money into the firm's innovation fund. In 2022, ARK Invest added $1.6 billion into the innovation fund alone, despite the large decline in value. This is very strange. Normally during a massive market sell-off, people sell and head for the exits. Not only that, but much of the selling was actually directed at ARK stocks, with everyone being told to sell profitless tech companies and classifying all of ARK stocks as so, even though that may not totally be the case. So there must be something unique about ARK Invest, which shares its research with the public and has a 5-year time horizon, contrary to the typical analysts who are always trying to predict valuations 3 or 12 months out. This strategy appears to resonate with investors, perhaps since they can look at the research and make their own decisions given the transparency of these ETFs, and it seems that they agree with the fact-finding, otherwise they would have dumped the shares long ago. The 5-year outlook is also interesting because you actually need a bit of an imagination, which is a different type of thinking, a more qualitative one, versus the conventional analysts who still have plenty of trouble compiling the spreadsheets to calculate a company's earnings just 3 months out. A lot can change in 5 years. Companies can add completely new product lines during that time frame, which may not be reflected at all in today's valuation numbers, since the products don't exist, and neither do their revenue streams. ARK's innovation fund top holding continues to be Tesla, as the firm has recently begun buying Tesla once again, almost every day it seems, to keep the position close to their limit of 10% of their holdings, even as the stock falls. ARK analyst Tasha Keeney seems to have had enough with the sell-off in Tesla, and recently tweeted that removing autonomous driving and any form of ride-hail, which we believe will drive greater than 60% of Tesla's value over the next 5 years, our 2026 price target would become roughly $500 per share post-split, based on EVs alone, more than a 4x increase from the current price. Now this is interesting, especially coming from Tasha Kini, since most of her research at ARK Invest has been centered around the autonomous, robotaxi, and ride-hailing business side of things, although she does cover manufacturing as well. But she's saying that if you completely ignore basically all of her work on robotaxis and just look at Tesla's vehicle sales as if it were the entire company, Tesla would still be worth $500 per share in 2026, and today it's trading at around $120 per share, implying a 4x in 4 years. But again, they still believe in the autonomous vehicle story. Tasha Keeney is simply implying that Tesla's valuation has gotten absurdly affordable even if you back out what most people would still consider to be up in the air, the robotaxi business, even though ARK is quite confident in Tesla's technology. And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and a brand new set of financial data going back 15 years, and it's all freely available. Now, Tasha Kini points to her research paper, which estimates a $4,600 valuation, but these numbers should be divided by 3 to take Tesla's 3-to-1 stock split into consideration. So they expect a $1,500 share price by 2026, including the autonomous business. But let's just look at vehicles alone, as the tweet implied. In 2021, Tesla delivered 936,000 cars at an average price of $49,000. Tesla's market cap back then was just over $1 trillion, and they use enterprise value over EBITDA as their multiple, and Tesla had an 86 times multiple back then. Well, a lot has changed in less than a year. We know now that Tesla delivered just over 1.3 million cars in 2022, and we don't know the exact average price since the Q4 earnings haven't come out yet, but Tesla had to raise its prices all year in order to keep up with rising input costs. The average selling price would be much higher. In the third quarter, for instance, it was about $53,500 on average for a vehicle. In the fourth quarter, it may be even higher, but what we do know is that Tesla has begun to cut prices back down in 2023, starting with China. And the mainstream media and analysts always attribute this to slowing demand in order to spook shareholders. But according to a Tesla VP in China, as tweeted by Sawyer Merritt, Tesla lowering prices reflects their estimated future costs, and more importantly, it appears that Tesla's supply chain is getting much better, certainly as compared to last year. And if you look at some of these other companies, like General Motors, for instance, a global car company, but many other automakers as well, including China's BYD, these companies are raising prices now because of increased supply chain cost, subsidies ending, and input costs, at a time when Tesla is able to do the opposite and lower prices. This is bad news for these companies since Tesla can lower prices and still make money with their high margins, and these other players need to raise prices to maintain their low margins. This makes Tesla vehicles much more competitive in the market and puts pressure on all of these other automakers. Now, naturally, Tesla has to lower prices over time, but this is always viewed as a weakness, and institutions sell the shares when they hear of price cuts. Interestingly, on Monday this week, when we learned of Tesla's price cuts this time round, the stock actually went up, which may be a signal that this is indeed bullish for the company, especially after it's been hammered for over a year. But really, it's impossible for Tesla to sell many millions of vehicles at $54,000 a piece, as the larger scale auto market simply can't afford that. And so investors are jumping up and down for Tesla to come out with a new, cheaper model vehicle, but lowering prices on the existing ones, the Model 3 and Model Y specifically, because Tesla is able to reduce the cost to build one, is effectively the same thing and on the same path to a lower priced car. And that's why ARK Invest has forecasted a decline in selling price as Tesla's volume increases, again, necessary for hitting the mass market. So it shouldn't be viewed as a negative to cut prices, but instead as a positive, since Tesla is on the right track to actually hit the mass market. And again, if they can do that, they'd be eating into everyone else's share. Now, ARK's 2026 bull case calls for 17 million cars. This would actually be ahead of Elon Musk's own estimates of selling 20 million cars by 2030, assuming a 50% growth rate on the way to getting there. So ARK's bull case assumes Tesla will hit that goal early. And interestingly, their bear case for 2026 calls for 10 million vehicles, which is still pretty aggressive. That would be above Tesla's 50% growth rate, where in 2022 they were closer to 40%. But that may be attributed to the China factory being shut down for a month and then taking time to ramp up, which is estimated to have cost Tesla about 100,000 vehicles, which would have helped them hit their 50% growth target. If we grow Tesla's 2022 actual sales by 50% per year, we end up with just over 6.5 million units delivered in 2026. So ARK is ahead of that with 10 million in their bear case. They also have an average price of $38,000 per vehicle. This makes sense if Tesla can actually get to 10 million units, but if they fall short of that and only hit 6.5 million units, I think the average selling price would remain much higher, especially since Tesla's Semi and Cybertruck are the vehicles that will be ramping up next, which will contribute to raising Tesla's average price per vehicle. Even if they come out with a new, cheaper model, Tesla always sells the higher end versions first, to help it get to profitability more quickly. The point is that ARK's vehicle-only estimates may be a bit aggressive even with a 50% growth rate in every year, but to be fair, even if Tesla misses their targets, lower unit sales but higher average price would still get fairly close to their numbers. Nonetheless, if you stick with Tasha Keeney's $500 per share price target for 2026 and you discount that back to the present at a reasonable 16% discount rate, you still get a $276 share price for Tesla stock today, but just based on cars. Now, it doesn't look like Tasha Kini is advocating for basing Tesla's price just on cars. Her point is to show that Tesla looks cheap even if you look only at cars. But this goes back to what was said earlier, which is that the analysts are looking only at cars. And that's because they have a short-term time horizon. They can't picture anything else out into the future, such as the existing energy business, robotaxis, robots, perhaps even new types of cars, all of which should be part of Tesla's valuation, even if they don't have revenue streams today. Because we need to look at the future cash flows that these businesses bring in and discount them to today, which would be a non-zero positive number added to Tesla's valuation. So this in part explains why institutions dump Tesla, because they're inherently focused on the short term, looking at only a fraction of Tesla's business and on how it's performed over the past 3 months, and they likely have far less aggressive targets than ARK Invest in their models. And so now what's happened, according to Tasha Keeney's research table, Tesla has gone from an 86 times enterprise value over EBITDA down to 21 times, far earlier than ARK would have expected, as they were predicting this drop to really occur in 2026, presenting them with an opportunity, especially since their 5-year time horizon allows them to ignore short-term emotions that cause quarterly fluctuations. So do you think Tasha Kini is right that the current price of Tesla barely reflects the vehicle division on its own? Or is ARK's 10 million unit bear case by 2026 still too bullish? How many vehicles do you think Tesla can deliver in 2026? Don't forget to watch my previous very important video on Tesla's outstanding new safety designs. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.